In our view, current risks are quite high. We're now 6 years into the bull market rally, which has primarily been driven by cheap money and low interest rates. We now head into a period where the US Federal Reserve is winding back its stimulus and also talking about raising interest rates. This is going to create uncertainty and volatility for markets because the Fed's never had to raise interest rates from zero before. Adding to this risk is geopolitical tensions in the Middle East with ISIS, and also between Russia and Ukraine, and more recently the protests in Hong Kong. So markets still face a lot of risk going forward. At Morrows, our philosophy is to manage risk in addition to generating return. We want to ensure that investors are being rewarded to take on risk. So what we look to put into portfolios is less reliance on market direction and more reliance on generating a positive return regardless of whether markets are rising or falling. However, to put that type of protection in place, we have to potentially be prepared to give away some upside when markets are rising strongly. Investors shouldn't focus only on return, they should also look at volatility of returns. If we look at the Australian share market, for the 2014 calendar year to date, it's actually slightly negative. So investors haven't made any growth return, they've only been rewarded by dividend income. So rather than focusing on are we missing out on the upside from equity markets, investors should be focused more on am I being rewarded to take risk. In some instances, investor expectations are too high. There's still a perception that you can achieve a better than 5% return from term deposits, whereas in reality that return is more like 3 to 4%. So achieving a high single digit or low double digit return is very hard in a low interest rate environment. Those investors that do want higher returns need to take on a lot higher risk, but with that higher risk comes the risk of losing your capital. Investors shouldn't be solely focused on returns, they should also be looking at the risk that they're willing to take. So if your returns are lower than expectations, that's probably because you're taking less risk. If you want those higher returns, then you can add more risk to your portfolios. But again, you need to be concerned about the risk of losing your capital in that type of environment. Investors can go to the Morrows website where they can view the Morrows investment philosophy and how we go about managing client money with that focus on managing risk and generating returns. On the website we've also got our regular monthly updates and webinars which explain our views on markets and where we see risks and what we think investors should be focused on. And they can also come and talk to their advisor and really discuss their risk and return outcomes so that their objectives can be achieved over the long term.